On one Monday in February of 2018, the S&P 500 fell about 4%. Not a crash. It was only the 31st worst day of the prior decade. But the market's fear gauge, the VIX, more than doubled in a single session. The biggest one-day jump in its history. The sell-off was ordinary. The panic was not. And the difference came down to one hidden level that almost nobody outside a dealer desk ever watches. That level has a name, the gamma flip. Above it, the market tends to calm itself. Small moves get faded and boring days follow. Below it, the market feeds on its own moves. A small push becomes a slide. Here is the payoff up front. You do not need to trade a single option to use this idea. You just need to know which side of the line we are on. Because the same headline can produce a gentle wobble on one day and an air pocket on another. And often the difference is not the news at all. To see where that level comes from, start with a simple question. When you buy an option, who sells it to you? Usually not another small trader. It is a market maker, a dealer. Their job is to quote a price, take the other side, and earn the spread. What they do not want is a directional bet. So the moment they take your trade, they hedge it. Say you buy a call. The dealer is now short that call. If the stock rises, the dealer loses. To cancel that risk, the dealer buys some of the underlying stock. How much? It depends on how sensitive the option is to the stock. That sensitivity has a name. Delta. A deep-in-the-money call moves almost 1-for-1 with the stock. A far out-of-the-money call barely moves at all. So the dealer holds shares in proportion to delta. Here is the catch. Delta does not stay still. As the stock climbs toward the strike, the call gets more sensitive and its delta grows. So the dealer has to buy more shares just to stay neutral. As the stock falls, delta shrinks and the dealer sells shares back. The dealer is not predicting anything. The dealer is only staying balanced. The rate at which delta changes as the stock moves has its own name. Gamma. And gamma is where calm and chaos are decided. Picture the most common setup. Traders and funds are buying call options. The dealers, in aggregate, are short those calls. When you are short the options you sold, traders call that being short gamma. And short gamma hedging runs in the same direction as the move. The stock rises. Delta on those calls rises. To stay neutral, dealers buy stock. Their buying lifts the price further, which lifts delta again, which forces more buying. It is a feedback loop. The hedge chases the move instead of fading it. The same machine runs in reverse on the way down. The stock falls. Dealers must sell to stay balanced. Their selling pushes it lower, which forces still more selling. A normal dip turns into an air pocket. Nobody at the dealer desk wants a panic. They are just staying neutral. But when the crowd is positioned this way, neutral is not calm. Neutral pours fuel on whatever the market is already doing. But it is not always like that. Sometimes dealers are long gamma. That happens when their net position means they hedge against the move instead of with it. Long gamma dealers sell as the market rises and buy as it falls. That is mechanical mean reversion. It pins the market in place. Small moves get quietly faded and days feel slow. So the same market has two personalities, depending on which way dealer gamma leans. The crossover, where aggregate dealer gamma passes from positive to negative, is the gamma flip. Now, the honest part. That level is not printed anywhere. There is no official feed. Analysts estimate it from the gamma of every option, its open interest, the contract size, and the price, then they have to guess which side of each contract the dealers are on. The exchange data does not say, so different desks publish different flip levels for the same day. The chart on screen is a schematic, not a live reading. The point is not the exact line. The point is that crossing it can switch the whole market from self-calming to self-amplifying. Go back to that Monday in February of 2018. The drop in stocks was ordinary, about 4%. But underneath, positioning had tipped into the amplifying regime. As prices fell, the hedging required more selling, and a crowded bet against volatility blew up at the same time. The VIX went from around 17 at the prior close to about 37, more than doubling in one day. The selling fed the selling. And there is research behind this pattern, not just storytelling. A study of same-day options found that when market makers hold positive gamma, it tends to dampen intraday moves and strengthen reversals. When that gamma turns negative, it tends to strengthen momentum, meaning moves keep going. Positive gamma above the flip absorbs shocks. Negative gamma below it magnifies them. The people hurt were not the dealers. They were hedged. It was everyone who assumed yesterday's calm would carry into the next day. So the next time the market shrugs off terrible news or falls apart on nothing, you have a sharper question to ask. Not just what happened, but which side of the flip are we on? It will not tell you what comes next. It is a lens, not a signal. And here is why it matters more every year. That hedging pile keeps growing. On a single Thursday in June of 2026, a record $8.3 trillion in options notional expired at once. When that much gamma rolls off in one session, the level it was defending can move underneath everyone's feet. The forward question to sit with. As more and more trading crowds into options that expire the same day, does the line between calm and chaos get thinner? More breakdowns of the market's machinery are on the way. This channel explains how markets work. It is educational, and it is not financial advice.